Hello everyone, and welcome to today's presentation. I'm excited to have you here as we explore comprehensive sales tax management in Business Central. On this first slide, you'll see the title, Comprehensive Sales Tax Management in Business Central, along with the subtitle, Navigating Nexus, Compliance, Setup, and Reporting for Effective Tax Administration. Over the next few minutes, we'll cover key aspects of managing sales tax effectively, including understanding Nexus, ensuring compliance, setting up your system, and generating reports. Let's get started. Welcome to Slide 2. Today, we're diving into the introduction to sales tax in Business Central. We'll explore how this comprehensive sales tax management tool can help you stay compliant and manage audits effectively. I'll share insights on handling sales tax documents, ensuring your records are in order. This foundation is crucial because understanding sales tax complexities allows you to leverage Business Central to its fullest potential. We'll also look at setting up the system to accurately account for and report sales tax, which is vital for compliance. Lastly, we'll cover the current sales tax environment, including recent changes that could impact your business operations. This knowledge will help you navigate the evolving landscape with confidence and ensure your business remains compliant and efficient. Keeping up with sales tax developments is absolutely critical for our business success. Staying informed about changes in the tax landscape helps us ensure we're collecting, reporting, and remitting the correct amounts on time. Failing to do so can lead to penalties and other compliance issues, which we definitely want to avoid. When we talk about compliance requirements, it's important to remember that sales tax applies not only to tangible personal property, but also to some services. Plus, use tax comes into play for out-of-state purchases, so we need to be aware of those obligations as well. States are constantly adjusting their thresholds, lowering transaction limits, and expanding revenue thresholds, which means more transactions and more revenue could be subject to sales tax. This makes it even more important for us to stay current. Another key point is economic nexus thresholds. Essentially, this means that if our business has a certain level of activity or presence in a state, we're required to collect and remit sales tax there, regardless of whether we have a physical location. These nexus laws are crucial because they extend our tax responsibilities beyond just having a physical footprint. Overall, navigating this current sales tax environment requires vigilance and good management. That's why comprehensive sales tax management tools, like those available in Business Central, are so valuable. They help us stay compliant and manage everything efficiently. Understanding Nexus in sales tax is a crucial part of managing your sales tax responsibilities. On this slide, we're focusing on the concept of Nexus and why it matters for your business. Nexus essentially determines when you're required to collect and remit sales tax in a particular state. It varies from state to state, which is why it's so important to evaluate your Nexus status regularly. You have Nexus if your business has a physical presence, like offices, warehouses, or employees located within the state. But it's not just about physical presence. Economic presence also counts. That means if your sales volume or transaction count exceeds certain thresholds, you might also establish Nexus. Now, let's clarify what Nexus really is. It's a legal connection that creates an obligation for your business to handle sales tax in that state. Recognizing whether you have Nexus helps you stay compliant and avoid penalties. So, as we move forward, keep in mind that understanding your Nexus status is key to managing your sales tax obligations effectively across different states. Let's take a closer look at the physical presence criteria for Nexus. These are the key factors that determine when a business has enough connection to a state to be required to collect sales tax. First, delivering goods using company vehicles is a clear indicator. If your business physically transports products into a state with your own trucks or vans, that creates a Nexus. It shows active involvement in that market. Next, activities like performing services or attending trade shows and booths within the state also establish Nexus. When your team is physically present, engaging with customers, or promoting your brand at local events, it signals a tangible connection. Storing inventory or tangible personal property, even in third-party warehouses like Amazon, is another critical point. If your products are stored somewhere in the state, it's considered a significant physical presence that triggers Nexus. Employing salespeople, consultants, or contractors who live or work in the state is also vital. Their physical presence and work activities tie your business to that state, creating a nexus. Lastly, having a physical location or office within the state clearly establishes nexus. A brick-and-mortar presence is often the most straightforward indicator that your business is engaged locally. Connecting this to the overall theme, understanding these physical presence criteria helps ensure your sales tax management aligns with state regulations. Recognizing where your physical activities occur is essential in maintaining compliance and avoiding potential issues. Let's take a closer look at what economic nexus really means. Essentially, it refers to the requirement for businesses to monitor their sales activity carefully in order to stay compliant with sales tax laws. This is especially important because, as your sales grow, your tax obligations can change significantly. Now, a pivotal moment in this area was the Supreme Court's decision in the Wayfair versus South Carolina case. That ruling really accelerated the adoption of economic nexus laws across the country. It shifted the focus from physical presence, like having a storefront or warehouse, to the actual sales activity happening online or remotely. Economic nexus laws are designed to work alongside the traditional physical presence rules. They expand the scope of who needs to collect and remit sales tax, especially for remote sellers who may not have a physical location in a state but are making substantial sales there. Some states have even combined metrics, like revenue generated and the number of transactions, to define when economic nexus kicks in. This means they look at both how much money you're making and how many transactions you're conducting. Typically, most states establish thresholds, say, between $100,000 and $500,000 in sales annually, or around 100 to 200 transactions. Once you cross these thresholds, you are considered to have economic nexus in that state. The key point here is that economic nexus is based purely on sales activity, not physical presence. So, even if you don't have a physical location there, if your sales volume is high enough, you could still be obligated to collect sales tax. Understanding these distinctions is crucial for managing your compliance and ensuring your business remains within legal boundaries as your sales grow across different states. Let's take a closer look at the difference between sales tax and use tax. First, paid by consumers on out-of-state purchases where sales tax wasn't collected at the time of sale. This is important because it ensures that tax is paid on goods that are used, stored, or consumed within our state, even if the seller didn't collect it initially. On the other hand, sales tax is collected by vendors on retail sales of tangible goods and certain services within the state. Vendors are responsible for collecting this tax if they have what's called nexus, which is a sufficient connection to the state. Essentially, while sales tax is collected directly from customers by vendors during a sale, use tax is something consumers owe when they buy out of state and didn't pay sales tax upfront. Both are vital parts of comprehensive sales tax management, especially when you're managing business operations across states. Let's talk about the risks of overcharging sales tax and why careful management is so vital. Vigilance in tax calculation isn't just about getting the numbers right. It's about protecting your business from costly compliance issues down the line. It's crucial to remember that you should never collect sales tax without actually remitting it to the right tax authority. This obligation to remit collected tax is a key part of responsible business practice. Implementing best practices, like applying accurate tax rates, properly handling exemptions, and making timely remittances, can help you stay compliant and avoid penalties. Failing to do so can lead to serious consequences, including fines, interest charges, and damage to your reputation. It's also important to be aware that civil penalties vary by state and can be quite substantial, especially if overcharging is found to be intentional. So, Maintaining vigilance in your sales tax processes isn't just about compliance, it's about safeguarding your business's financial health and reputation. Now, let's talk about how to determine Nexus and meet tax requirements effectively. This is a crucial part of comprehensive sales tax management in Business Central. First, it's important to review the Nexus criteria. This means evaluating both physical and economic presence in each state where your business operates. Understanding these criteria helps you identify where you have tax obligations. Next, leveraging online tools is a smart move. Resources like TaxJar.com, state tax websites, and SalesTax support. Com can provide valuable Nexus research and data that simplify this process. Once you've gathered initial information, consider conducting a formal Nexus study. This step is vital because it gives you an accurate picture of your tax obligations, minimizing the risk of errors. Following that, engaging with tax specialists or CPA firms experienced in sales tax, such as TaxOps LLC or Avalara, can provide expert guidance. Their insights ensure compliance and help you avoid costly mistakes. Finally, taking a proactive approach by performing a formal Nexus study and consulting with experts means you're not just reacting to audits or regulations. You're actively managing your compliance, which reduces audit risks and keeps your business aligned with tax laws. This proactive assessment really ties into the overall theme of effective sales tax management. Being prepared and informed is key to smooth operations. Let's take a closer look at setting up sales tax in Business Central. This slide provides an overview of the key steps involved in comprehensive sales tax management. First, addressing these questions ensures that Business Central can accurately calculate and report taxes. It's essential to get these basics right to stay compliant and avoid surprises. The first point is about understanding what items are taxable. To do this, you assign tax group codes to each item. This helps Business Central know which items should have tax applied and simplifies the process of managing different product categories. Next, we need to identify which customers and vendors are liable for tax. You do this by configuring their customer and vendor cards accordingly. Proper setup here ensures that you're charging or collecting tax only from the right parties. Then, it's important to determine the applicable tax rates. You set these rates per jurisdiction, since tax laws vary depending on location. This step guarantees that your calculations reflect the correct rates for each area. Finally, you define who you are collecting tax for by establishing tax jurisdictions and areas. This helps you organize and manage your tax collection process across different regions effectively. Putting it all together, these steps form a solid foundation for accurate sales tax management within Business Central, helping your business stay compliant and efficient. Now, let's discuss the importance of proper ledger setup for accurate tax accounting and reporting. First, it's essential to specify sales tax correctly in the VAT posting setup. This step ensures that the system knows how to handle sales tax transactions properly. Next, we need to set up the appropriate GL accounts for tax liabilities. Doing this correctly will guarantee that all tax postings are accurate and traceable. Finally, it's crucial to avoid mixing VAT and U.S. sales tax unless you're using VAT in the U.S. version of Business Central. Keeping these types of taxes separate helps maintain clarity and compliance. Overall, a thorough and careful setup of your general ledger is the foundation for reliable tax management in your business. Now, let's take a closer look at some of the key settings for managing sales tax effectively in Business Central. First, we have the option to set maximum tax correction amounts for local currency adjustments. This helps ensure that any corrections stay within reasonable limits, maintaining accuracy without overcorrecting. Next, there's the concept of unrealized tax. This is tax that has been calculated but isn't due until the invoice is paid. Managing this properly ensures our financials reflect the true state of receivables. We also have the ability to enable recalculations of tax amounts when posting payments that include discounts. This is important because discounts can affect the taxable amount, so recalculating ensures our tax calculations stay accurate. Lastly, we can specify whether payment discounts are calculated on amounts including or excluding tax. This choice impacts how discounts are applied and helps us align with local tax regulations. All these settings are part of our broader goal to have comprehensive sales tax management, giving us control and flexibility to handle different scenarios smoothly. Let's talk about configuring tax jurisdictions and how it plays a crucial role in comprehensive sales tax management within Business Central. First, it's important to organize jurisdictions in a way that reflects the real-world tax reporting structures. This means structuring them logically so that reporting is clear and accurate. Next, you'll want to group jurisdictions logically, which helps in managing multiple regions efficiently. Linking local jurisdictions to the correct tax authority is essential for proper reporting and compliance. This connection ensures that each jurisdiction reports to the right authority without confusion. Another key point is specifying report to jurisdictions. Setting up these relationships allows you to assign tax accounts for sales and purchases. Doing so guarantees that tax liabilities are posted accurately, which is vital for your financial accuracy and compliance. Finally, it's important to identify each taxing jurisdiction responsible for collecting sales or use tax. Defining these jurisdictions clearly helps avoid mistakes and ensures that the right authorities are credited with the collected taxes. All these steps together create a solid structure for managing your tax reporting effectively, aligning your business operations with the actual tax regulations. Now, let's talk about setting up tax areas for our customers and vendors. Consistency is key here, so it's important to use tax area codes uniformly across all transactions. This helps ensure that the correct taxes are applied every time, reducing errors and streamlining our process. Next, we need to define the calculation order within each tax area. This is particularly important when dealing with tax-on-tax scenarios, where one tax might be applied on top of another. Setting a clear order helps us manage these situations accurately. We also want to make sure that each tax area includes all relevant jurisdictions. This way, we cover all the locations where our business operates, ensuring compliance in every area. Assigning tax areas to customers, vendors, and locations is another crucial step. It reflects their specific tax obligations and helps us apply the right tax rules directly. Finally, remember that tax areas group together multiple jurisdictions for the purpose of tax calculation. They simplify the process, making tax compliance more efficient and manageable across our business. This setup ultimately supports our goal of accurate, consistent tax management in Business Central. Now, let's turn our attention to the customer card, tax settings, which are a key part of comprehensive sales tax management in Business Central. First, I want to emphasize that having an accurate customer tax setup is crucial. It ensures that the system calculates taxes correctly and handles exemptions properly, reducing errors and ensuring compliance. When setting up these details, make sure to record all relevant tax identification types, registration numbers, and exemption numbers when needed. This information is vital for accurate reporting and for handling any exemption processes smoothly. Next, you'll want to set the tax business posting group. This helps categorize your customers for tax purposes, making it easier to apply the correct tax rules consistently. Additionally, assigning the correct tax area code is important because it reflects the customer's tax jurisdiction. Different regions may have different rates and rules, so this ensures you're applying the right tax calculations. Finally, it's essential to indicate whether the customer is taxable and liable for sales tax. This setting determines whether taxes are calculated on transactions with that customer, which can significantly impact your financial accuracy. Overall, these settings work together to ensure your sales tax management is precise and compliant, supporting your broader goal of efficient and accurate financial operations in Business Central. Now, let's take a closer look at the vendor card tax settings and location setup. These settings are essential for ensuring that use tax is applied correctly and that vendor-related tax obligations are properly managed. The purpose of the vendor tax settings is to keep track of vendor tax exemption numbers and registration details. This helps us stay compliant with tax regulations and ensures that we're handling taxes accurately for each vendor. Additionally, location cards can store tax area codes. This is particularly useful when managing tax differences across various sites or locations within your business. It allows for more precise tax calculations based on where the transaction occurs. Sometimes, you might want to exclude certain vendors from tax calculations altogether. That's where the Do Not Use for Tax Calculation flag comes into play. It provides the flexibility to omit specific vendors from tax processes when needed. Finally, assigning tax area codes to vendors determines how their purchases are taxed. This setup helps us apply the correct tax treatment based on the vendor's location or the nature of the transaction, ensuring accuracy throughout the process. All these settings work together to give us comprehensive control over sales tax management, aligning with our overall goal of maintaining compliance and efficiency in Business Central. Now, let's turn our attention to sales and receivables setup, which is crucial for seamless tax processing. Proper setup here ensures that your tax calculations are smooth and accurate when dealing with payables. It's important to verify that your settings support precise tax calculations on purchase orders and vendor invoices, as these are key touchpoints in your business transactions. Additionally, you'll want to configure how your system handles payment discounts and tax differences, aligning these with your company's policies to avoid surprises and ensure compliance. Another important aspect is the vendor tax area code. You'll see a flag called Use Vendor's Tax Area Code, and this determines whether purchase transactions use the vendor's specific tax area or the location's tax area. Getting this set up right is essential for maintaining accurate tax calculations and ensuring your overall tax management process is efficient and compliant with regulations. Remember, these settings directly impact the accuracy and consistency of your tax data, which ties back to our overall goal of comprehensive and reliable sales tax management. Let's talk about item card tax configuration. Properly setting up tax group codes is absolutely essential for staying compliant with tax regulations. When your tax group codes are accurate, it helps prevent errors during tax collection and reporting, making the whole process smoother and more reliable. This setup is crucial because it ensures that sales tax is calculated correctly, taking into account the specific item type and jurisdiction. Think of it as assigning the right tax rules to each item so that everything aligns with local tax laws. Now, these tax group codes don't work alone. They integrate with tax business posting groups. This integration helps determine the correct type of tax transaction, whether it's for sales, purchases, or other tax-related entries. Finally, by assigning tax group codes directly on items, you control the tax rates that are applied. This way, you can easily differentiate between taxable and non-taxable products, ensuring that the right amount of tax is always calculated and reported accurately. Now, let's take a closer look at the tax group code and detail setup. This part of the system is crucial for ensuring that our sales tax is applied accurately and consistently across different transactions. First, it's important to understand that this detailed setup allows us to specify exactly how tax rates are applied, which is essential for compliance and precision. For example, we can configure maximum amounts or quantities for specific jurisdictions. This means that if a transaction exceeds a certain threshold, the rate can be adjusted accordingly, providing flexibility and accuracy. Next, we define the tax type, whether it's sales tax or use tax, along with the effective dates and the applicable rate percentages. This setup ensures that the correct rates are applied at the right times and for the right transactions. Then, we use the tax detail setup to assign these tax rates to specific combinations of tax jurisdiction codes and tax group codes. This linkage helps us manage complex tax scenarios systematically. Finally, we create tax group codes that categorize different kinds of taxes for various items. These groups help streamline the process and make it easier to apply the correct taxes based on the item or transaction type. By setting all of this up carefully, we ensure that our tax calculations are precise, compliant, and adaptable to different business needs. Now, let's look at how prepayment flags and tax inclusion settings influence the final tax amounts in Business Central. These settings are crucial because they determine how taxes are calculated and applied during a sales transaction. What's interesting here is that Business Central handles multi-jurisdiction tax calculations seamlessly. It automatically calculates and posts the appropriate tax for each jurisdiction involved in the sale, making complex tax situations much easier to manage. Specifically, tax is calculated separately for each jurisdiction. For example, state, county, and city taxes are handled independently. This ensures accuracy and compliance with local tax laws. For each jurisdiction, corresponding entries are posted. This means that the system keeps clear records for each tax component, which is vital for reporting and audit purposes. Let's take a closer look at an example of a sales transaction. The item, 150 Accelerator, uses a tax group code labeled tax. This code tells the system which tax rules to apply. In this case, the customer 1000 Smith Retail is assigned to the tax area WA 100. This area includes Washington State at a 6% rate, King County at 2%, and Seattle City at 1%. When all these are combined, the total tax rate for this customer is 9%. By assigning the customer to this specific tax area, Business Central automatically calculates the correct total tax amount based on the location-specific rates. This example illustrates how detailed and precise the tax management can be in Business Central, helping businesses stay compliant while simplifying complex calculations. Let's take a closer look at how Business Central's integrated tools make managing taxes much simpler. These tools help streamline tax tracking and financial reconciliation, so you can be confident that your records are accurate and up to date. Consistent and precise reporting is key to maintaining compliance and being prepared for audits, and Business Central supports that goal with its comprehensive features. For example, when it comes to use tax on purchase orders and invoices, the system processes these similarly to sales tax, with clear flags indicating self-assessed tax. This consistency helps reduce errors and makes tracking easier. You can also see how tax entries are posted directly to the general ledger for each jurisdiction, providing transparency and clarity in your financial records. Additionally, tax reports give you a summary of the taxes collected by jurisdiction over specific periods, giving you a clear overview of your tax obligations. And when it comes to sales tax reporting and posting, Business Central offers a complete, integrated approach, making sure all your sales tax management is efficient and accurate. All of these features work together to simplify your tax processes, support compliance, and keep your financials in order. They really embody the overall theme of making financial management more streamlined and reliable. Now, let's talk about the use tax on purchases and how we manage it effectively within Business Central. Proper setup is crucial to ensure compliance and accurate reporting of our tax liabilities on purchases. When everything is configured correctly, we can avoid errors and stay compliant with tax regulations. In Business Central, the processing of use tax is quite similar to how we handle sales tax, especially when it comes to purchase orders and vendor invoices. It's important to understand that use tax is often a self-assessed tax, which means we need to actively manage the tax groups, distinguishing between amounts that vendors impose and those we self-assess. One key element to look for is the use tax flag on purchase lines. When this box is checked, it indicates that use tax applies to that particular purchase. The system then posts the net amount to the vendor ledger entries and accrues the use tax for us to self-assess. Use tax typically applies to tangible personal property bought from out-of-state vendors who do not collect sales tax. This is where understanding the definition of use tax becomes critical. It's an assumed tax liability, which we need to track separately from vendor-collected tax to avoid errors in reporting. In summary, careful management and tracking of use tax ensure we stay compliant and avoid potential penalties. Proper setup, flagging the right purchase lines, and understanding the nature of use tax are all essential to managing this aspect of our tax obligations effectively. Now, let's talk about managing sales, tax certificates, and exemptions effectively within Business Central. It's essential to use dedicated certificate management systems or even external services to keep track of expiration dates and validity statuses. This way, you can ensure that your certificates are always current and compliant. It's also crucial to thoroughly document exemptions, as this supports your audit readiness. Proper documentation can save you a lot of trouble if an audit ever occurs. When it comes to tracking expiration and validity, you should be aware of different types of certificates. For multi-state transactions, forms like the Streamlined Sales and Use Tax Agreement, or SSUTA, are commonly used. Additionally, each state may have its own specific forms, such as NJSD3, NYSD121, and VASD12. Resale certificates are another important aspect. They're used when purchases are meant for resale or incorporation into other products. Always make sure these certificates are valid and properly documented. Speaking of validity, ensuring that certificates comply with each state's specific rules is vital. Non-compliance can lead to liabilities, including unpaid taxes and penalties, which we definitely want to avoid. In Business Central, it's important to keep these certificates up to date and linked directly to customer or vendor records. This helps maintain accurate records and simplifies compliance checks. Finally, remember that sales tax exemptions are only valid if the supporting certificates are current and valid. Having the right certificates in place means you won't accidentally collect tax on qualifying sales, which is both good for your business and keeps you compliant with state regulations. Now, let's discuss how to handle sales tax audits and ensure proper documentation. First, it's crucial to train your staff on maintaining the right documentation and retention policies. This way, if an audit request comes in, you can respond promptly and confidently. For more complex situations, especially those involving multiple jurisdictions, consider bringing in external tax consultants. Their expertise can be invaluable in navigating complicated audit processes. Another key point is documenting all nexus determinations and economic thresholds assessments. Keeping clear records on these helps justify your tax collection practices and demonstrates due diligence. Regularly reviewing and reconciling tax postings with your general ledger is also essential. This practice helps you catch discrepancies early, maintaining accuracy and compliance. Using Business Central's reporting tools is a great way to generate detailed reports on the tax collected and remitted by jurisdiction. This provides transparency and easy access to your tax data. Additionally, maintaining organized, accessible records of all sales tax transactions, exemption certificates, and filings ensures you're prepared at any moment. Ultimately, being proactive with audit preparedness reduces your risks and keeps the process smooth. Proper documentation, regular reviews, and leveraging the right tools all contribute to a solid foundation for managing sales tax audits effectively. Let's take a closer look at the comparison between BC's built-in sales tax and external systems. On this slide, we see that the built-in sales tax feature offers comprehensive management directly within Business Central. This includes automated tax rate management and certificate tracking, which helps ensure accuracy and compliance without much manual effort. It also provides filing services, reducing the risk of late or incorrect submissions, and alerts for expiring certificates or changes in regulations, keeping you always up to date. However, there are some trade-offs to consider. The built-in system can come with higher costs, and integrating new systems or updates may take longer and involve a steeper learning curve. But on the plus side, setup is straightforward with no additional integration costs, and you can start using it immediately for limited states and customers. Plus, it gives you direct control over tax rates and certificate management right within Business Central, which can streamline your processes. In contrast, External tax systems often require manual updates for tax rates and certificates, meaning more hands-on management on your part. Filing responsibilities also fall on the user, which can introduce risk if not managed carefully. While external systems might have their advantages, the built-in features are designed to simplify compliance and reduce reliance on third-party solutions, aligning with our overall goal of making tax management easier and more integrated within your business processes. Let's talk about some best practices and compliance tips for managing sales tax effectively in Business Central. First, it's crucial to avoid overcharging or undercharging tax. Both mistakes can lead to serious penalties, so accuracy is key. Next, keeping your tax setup up to date is essential. This means regularly reviewing jurisdiction codes, tax groups, and rates to reflect current regulations. Using Business Central reports can help you monitor the tax you've collected, what you've remitted, and any tax liabilities that might be outstanding. This helps ensure everything is accounted for correctly. Managing exemption certificates proactively is another important step. Always verify their validity and keep proper documentation to avoid issues later on. It's also vital to regularly assess your nexus, meaning the states where you have a tax obligation. This includes not just physical presence, but economic thresholds as well. Staying on top of this ensures you're compliant everywhere you do business. Finally, never forget that collecting sales tax isn't just about collecting. It's about remitting it promptly to the right authorities. Consistent and timely remittance helps you stay compliant and avoids penalties. By following these best practices, you'll be well on your way to maintaining a compliant and efficient sales tax process in Business Central.